So as Toby said, today's session is really an important one, which a lot of you are really grappling with is, should I incorporate private assets into my client portfolios? And if so, how do I do that in an effective way? It's really a challenge. Obviously, this is an IMAP session, managed accounts are front and centre. So we're going to unpack, should that sit inside a managed account? Should it sit outside? What are the different vehicles and what are the different parts of the private assets complex? We're going to have some expert speakers covering off different parts of the private markets landscape. And the idea of today's session is really to give you guys insights and also have a discussion at the back end around the different concerns and challenges you're facing in your practices, and obviously hearing from the experts and their opinions. So we're going to have 4 presenters. At the end of each presentation, there is going to be a time for a short Q&A, time permitting, if everyone keeps to their allotted time. And then we'll wrap it up with a panel discussion at the back end. So with that, I'll pass over to the first speaker. We've got Kieran Canavan, Chief Investment Officer from Findex Group. Kieran began working in financial services industry.
I'm sure you don't need to do all of
that. A great track record, long career in the industry, and I'll pass over to Kieran to kick us off.
Yeah. Look, thank you so much. I think this is quite a small group, so I'm very happy if there's questions as I go along. I've got a couple of slides up front, which I'm actually going to go through relatively quickly because they just set the context of the way we look as a firm and our team looks at, private type of assets. So please stop me along the way, but the first couple of slides are going to be relatively quick. Obviously, the disclaimer. When we look at our MDA ecosystem, when I'm talking about this, we're really going to be talking about what we do in depth within this ecosystem. So the main parts of the ecosystem, realistically, we're running managed discretionary accounts, not managed accounts. I think that's probably one distinction. So that does allow us a bit more flexibility than in the managed accounts. That said, there's probably a lot of clients within our firm that we could use in a managed account scenario. So if we look at it, we really have an investment committee, which is the governance structure, has a lot of very competent people on it, people with a lot of experience, like Emmanuel Kalageris, Tony Breen, etc. That governance structure we find is incredibly important, and it becomes even more important when we start talking about private assets, because the people that are governing the decisions we make, do they have the experience? Because private assets, there's some things that are really difficult within there, especially the valuation of private assets, because you could take the word of anyone that's selling you a private asset, but at the end of the day, you've got to, and APRA has said this to a lot of the industry funds, you've got to understand how to value those private assets, because a lot of the industry funds have ended up with the same asset from 3 managers, 3 different valuations. So if you're going to get into private assets, you've got to understand how to value them. We use asset consultants as well, so we've got a team internally, but we are using people like BCA, JP Morgan, Goldman Sachs, and State Street that provide consulting services to us across various areas, from strategic to tactical asset allocation, but then also underlyings as well. The team that we have, there are a couple of various areas, and probably worth pointing out here. We've got the model investment functions, which are really around SAA and TAA. So we run models within Australia and New Zealand. We run New Zealand in a DIM structure, which is the same as an MDA. What's really important, and when it comes to private assets as well, is this investment reporting and monitoring the performance. That's a lot more difficult to do. And then the research, the selection and monitoring, and I've got some specific slides on, how do you go and choose managers, because it's a different skill set when you get to these managers. There's not as much information as available. Governance oversight is important. We spend a lot of time as well on this part here, which is the advisor. At the end of the day, there has to be a very clear, deep link between what the research team, the governance teams are doing, and how does the advisor work with everything in there? How do they communicate it to their client? What is it going to feel like when they have these assets? And the rest is fairly simple. So when we think about building portfolios, when we're talking about private assets, and really we'll probably, when we talk about ours, talk about alts. We've run an alts program that has got private assets since about 2018. We probably run today in the liquid alts about $1 billion, and then individual managers probably another 700-800 million. When we look at our MDA portfolios, first distinction when I'm talking to you is we have got MDA portfolios, which are for our general clients. There's about $11.5 billion in there. Those general clients are all seen as retail because we manage the MDA on IDPS and super. So for us, a really big part of looking at private assets is how do we get those private assets in an appropriate format into IDPS and then superannuation as well. But we also do look at them, and everything that we do, we consciously are aware that within our firm, there's a lot of clients that are wholesale clients. So, and that can be not-for-profits, can be family offices, it can be endowments, it can be foundations, etc. So when we're looking at the private assets, we're looking at it first and foremost through the MDA structure, but then anything we use there, we want to still have access to those private assets for those wholesale. But it's a lot easier to provide access to the wholesale clients. So when we look at these, really, we look at it from an SAA. So we have a top-down SAA where we're looking at capital market assumptions, looking at the objectives that the advisors need and clients need within those portfolios, set a strategic asset allocation framework. We do that with those consultants, BCA and State Street primarily. Then we start talking about portfolio construction, and I'm going to spend quite a bit of time going through why we think these sorts of assets are so important in portfolios. And I think that sort of became clear earlier on today as well, that these alternative assets, these private market assets, have got a real role to play within portfolios. And you see that in the industry funds, and you see it in institutional, very large institutions running money. So we then have a tactical asset allocation framework. So when we're thinking about these private assets and you're thinking about tactical or dynamic asset allocation, you've really got to think about how do you work with them. Because not a lot of them are necessarily liquid. You may find structures that are designed to give you liquidity, but at the end of the day, if there's a mismatch in liquidity, you don't necessarily want to be rebalancing if you're trading at a big discount to NAV. And you don't want to be a forced buyer when everything's trading at a premium to NAV. So tactical is important, and it's important in then how you construct these and get into these private assets with a tactical overlay if you're going to use a tactical overlay. A lot of work on the manager research, a lot of work's done in there. However, what we do acknowledge is that the alt universe is very complex and it's vast. So we tend to work with partners in that space, and the partner in that space that we deal with is Grosvenor, GCM, Grosvenor Capital Management out of the US. They've been doing this for since 1971, so quite a couple of years. And then we build target portfolios. Now the portfolios, if I look at the portfolios and I look at what we're building for our retail clients, they are similar sort of portfolios. They will run across the efficient frontier from a very conservative portfolio to a high growth portfolio. And because they're on platforms, all the assets need to have retail disclosure and they need to be liquid. And I put inverted commas because that liquidity sometimes will dry up because of price. But when we build portfolios for wholesale clients, we can still use the framework of SAA, TAA, all of those things, but you suddenly get a very different type of portfolio. So we have a family office that we've done portfolios for. If I look at their portfolio, which is probably more towards a growth portfolio, our retail portfolios might have sort of 15 to 20% in alts. Theirs would have at least 40% in alts, and their alts would be going in at a very illiquid wholesale structure. And then ongoing management and reporting, I think there, once again, valuations on private assets, it is a skill set that's difficult to come by. So once again, we rely on our partners and third-party validation of that. If you're doing unit pricing on a fund that is a PE fund or something like that, and you're doing monthly unit pricing, how do you actually do the valuations on that? We deal with one hedge fund out of the US, which we're bringing to market now for wholesale investors. Their team is on a separate floor, external value overlays on that. Their teams are bigger than most industry funds teams. Their valuation teams bigger than most industry funds investment teams. So it's something that I think you need to use externals to help with. At a high level, what are we designing the portfolios for? Really for us, for our clients, we're talking about capital security, the ability to compound. So that's quite important. As we talk through these assets, you'll see why these assets work quite well. Real versus nominal returns, obviously in high inflation, that becomes really important. Risk management, liquidity, and risk versus reward. So alternatives is a growing market. You can see the numbers there. 17 trillion is a large number. 1.5 trillion in Australia. And if we look just at private credit, we've seen globally that now is above, and these numbers are probably already outdated because it's growing so quickly. 2 trillion. Private credit has seen growth here in Australia that is absolutely incredible. So I think we're already sitting over the $200 billion mark, and I'm sure some of you know the managers that are in there. But just as a bit of an aside, when you start thinking about, well, if we look at things that are similar, so this is looking at, and sorry, it didn't copy across all that well, but it's BBB structured credit, and it's comparing the spreads here, down the bottom here, for the public markets, and this is the weighted average loan term, and up here, the private markets for exactly the same. So you'll see here, European CLOs, private, have got a spread of 650. European CLOs, public, spread of 325. So very clearly, you can straight away start seeing that being in private markets, you're going to have a potential to earn a lot more. There comes additional risk with that as well, liquidity risk, etc. So stop me along the way if you've got any questions, because I'm going relatively quickly through this. So just a couple of things. Why do alternatives matter in portfolios? So we're just looking at this, alternative investments on that side and then traditional investments here. And we have a look at what they do through various regimes. And the regimes are recovery, expansion, slowdown, contraction, probably the standard regimes that you all know. And then we're looking at private equity, private debt, real estate, hedge funds, infrastructure, and then we're looking at the S&P, the MSCI World, Russell, High Yield Index, etc. What you'll see, and one of the reasons we really like the alternative investments in the private sectors is you're getting significantly lower drawdowns pretty much through all the regimes that are there. But your upside capture is still pretty high. So just looking at when we're looking at building portfolios, benefits of investing in private markets, these will probably be what you all know anyways, illiquidity premium. So it's getting the premium for something that's illiquid. So you can still get that premium even if you take something and you try and make it liquid. Because your underlyings, you should still get the liquidity premium. Lower volatility than traditional markets, less correlated with public markets, broader investment opportunities, and a large number of companies today, private companies, are staying private for a lot longer. So that investment universe is very different. But when we get to the risks, and these are the risks we see. So I'm not saying that they are necessarily the risks that you would see in your portfolios or what you might be worried about for your clients. Or if you're on the product side, there might be risks that you say, well, I'm actually quite fine with it. People understand it. But when we're building portfolios, these are really important for us. So we see similar risks to the public sector, which is your currency, country, sector, those sorts of things. Currency in private assets tends to be harder to work with. It's harder to hedge. Key difference to call out, though, is valuation risk. So strong governance is the key. I spoke a bit about that earlier on. And then the complexity of the underlying assets and the structures. So those asset structures that can be in private credit and those things are a lot more complex. But one of the things that worries us quite a bit is this potential mismatch between the underlying investment and the vehicle that you're accessing it through. So when we've built this for ourselves, we tend to build the vehicles ourselves, and because we know it's just our clients in there. So we've got more control. One of the issues is if you've got a mismatch on liquidity and you've got a very broad section of clients, what tends to happen is you've got very little control on when people start coming out. So what you saw through the GFC with some fund managers, we did say a bit about it this morning, is that they started off with maybe sort of 70, 80% in public markets, very, very liquid, and then sort of 30% in more private markets, very illiquid. As the GFC hit, a large swathe of people started selling. They actually gave liquidity, and that very quickly became 90% private, and then they locked. And some of these funds locked for 8 years. So it's understanding the nature of that. And if you're happy with the nature of it, that's fine. So I think you just need to understand the benefits and drawbacks. And I'm going to come through to what we do in a moment, which is a way that you could sort of think about, could you do it that way? So if we look at these, manager selection is really important. I think this is something that as you start looking, because it's something that's not really done a lot in Australia yet, but as you start looking at accessing private equity, private credit, various alts, infrastructure, etc., is really understanding that selecting the right managers is going to be super critical. If you look at the various differentials there between the top managers and the bottom managers, it is absolutely stark. If you end up with a bottom set of managers down there, that is a substantial downside to you and your portfolios. It negates any reason for going into these types of assets. Preservation of capital in down markets. Once again, here we're looking, actually, this was just a bit of work that we did on hedge funds in our own particular alts. So in down markets, obviously, you've got a lot less downside capture. You're still getting around about 50% market upside capture. So just important, once again, if you think about the portfolio construction and you're blending public market assets and you're blending private market assets, is the downside capture is a lot less. You're going to have less volatility in those portfolios, but you're still going to have reasonable growth. Once again, tailwind for alternatives in particular, but it'll go in private equity and that as well, is if we have a look at the annualized returns on the left-hand side for hedge funds and equities, and then you look at the Sharpe ratio of those, there's a real benefit in having those sorts of things from a portfolio construction point of view. So your absolute returns and relative performance to equities under different interest rate regimes is actually really, really positive. So I'm going to run through a bit of our journey now and what we have done. So for us, the very first thing I'll say is we use Grosvenor. I think you heard the guys from Evidentia this morning. They're using, I think, iPartners. You need a really good partner. My view is, sorry? iCapital, sorry. Thank you. I knew that. At least I got the I right. I think from that perspective, you need a partner in there that can really deal with the complexity of these sorts of assets. For us, when we built them, we wanted to build exposure within alts on a growth exposure and on a defensive exposure. And what we ended up using Grosvenor for the growth, and we used Wellington for the defensive. So for us, when we build something like this, the concept, as I said to you, is we have retail clients that are in an MDA that are on platform. So we need to get whatever product we don't get using, have to get that into Super and IDPS. But what we're trying to do when we build these, we will build a strategy and we will wrap the PDS ourselves. So we acquired an RE so that we could wrap ourselves. We will build the PDS. We will build enough liquidity into those PDSs, either via the underlyings or using, as we do with Grosvenor, a line of credit from RBC, that we know we can keep it liquid and we can manage what the super funds need to do, because they need to be able to pay out on death benefits. So they've got a period of time they've got to pay out the death benefits. So not everyone's going to die at the same time, so you've got to convince them that there's enough money for them to pay out. And that the fund can pay out, and then also if there's hardship. And we saw that probably the best example was 2020 through COVID, where people could draw into their superannuation. So both of those don't mean that you have to sell the fund down to zero. So all the discussions, and we got this on multiple platforms, with the trustees is always giving them enough confidence that there's enough liquidity there for our set of clients. It's easier for us to do because it's a captive set of clients, and we're building those portfolios. The other thing, when we build these vehicles, the underlying vehicles will typically be either a Cayman's vehicle, or it'll be an Australian unitized trust that goes into a Cayman's or a UCITS vehicle. So for us, when we build these, although we want the front-facing vehicle to be retail so we can use it in MDA, those underlying vehicles can all be then accessed via wholesale investors. So we run within fixed income, we use private credit, we run with Insights, we run with Schenkman. Schenkman's a very big US manager. We seeded them with a very large super fund, industry super fund here. They created a wholesale trust. We just pushed that wholesale trust into a retail trust. How are we going on time? We don't have one of those little time things there. 5 minutes, yeah, okay. So just running really through, once again, and these slides will be available to you, so you can have a look at it. This is just drawdowns. If you have a look at alts and how they play out, this is just a summary of the previous one. So you can see huge performance of growth. These are growth alts when the MSCI equity was down. And the relative performance is staggering. So 24 months, 22 of those months, that was the outperformance in bringing that into a portfolio relative to having the MSCI equity. I might just pop past that. I'm going to talk now just a little bit about some of the strategies that we use in private credit. So once again, that's what I'm saying, it's so important to actually understand, if you're going to go into these, what are your underlyings? And what is the risk in those underlyings? So for us, when we looked at private credit, we actually feel pretty comfortable with private credit in warehousing. Why? Because warehousing, you've got a lot of assets in there. They're much more liquid assets. So it's highly diversified. The valuation risk is less, etc. So for us, when we went into private credit, that's the area we wanted to play in.
When you say warehousing, Kieran, do you mean physical warehousing or do you mean financial?
Sorry, financial warehousing. So private credit. So private warehousing as in warehousing of mortgages, debt, etc. So that was just a place that we really wanted to play. We, from that perspective, actually deal with Realm, their strategic income fund, which has that. So we don't necessarily always go for an underlying that we have to wrap. We'll use what's in the market as well if we think it's appropriate. Maybe just talking a little bit about our wholesale client offerings. So there's a concept when you're looking at PE and other things and infrastructure that a lot of the institutions and the ultra-high net wealth clients and the family offices look at, and that is the co-invest. So when you think about co-invest, if you're going into a PE firm, you might be paying 2 and 20. But if you've got really big investors and they're putting 50 million into a PE firm, what they will expect is another 50 million or whatever it happens to be. It might be 25, it might be 75. That's co-invest. That co-invest doesn't have the general partner, the GP, the hedge fund, or the private equity fund, whatever it is, it doesn't have their fees on it. So it doesn't have the 2 and 20. So when you think about it, if you're putting 50 million into a GP at 2 and 20 and you're putting another 50 in the co-invests they give you, your fee's not 2 and 20. It's 1, because you have no fees at all on the co-invest, and then your performance fee, depending on how and when it's charged, because that's another thing to watch out for when you're getting into private equity. If you end up paying performance fees and it's not on realization of an asset, those performance fees, especially if they compound over a period of time, can be exceptionally high. So the way we're looking at that now, and what we're bringing out to our wholesale clients, is a co-invest platform. So a co-invest platform, because if you think about it, it's very difficult to manage co-invest unless you're a very big player. So for smaller players, what we wanted to do is have a co-invest platform that allows clients to get into various verticals. So we'll actually run 5 verticals: private equity, private credit, infrastructure, absolute return, and then opportunistic. And to give you a sense of what that looks like from the investor's point of view, they will go, so there's no GP on here, there's no fees in there. They'll get 20 to 30 co-investments. That's the structure in PE, private credit, infrastructure. So I think as you're thinking about these things, and I see some of the people that I know here that work in this, like Sam that's here as well, people are thinking about that. So what you need to look at is how do you also potentially get access to the co-invests, because that substantially changes the metrics when it comes to fees, outcomes, etc. But you need a professional manager managing it. I don't think as an IFA or an advisor, you want to be sitting trying to manage a whole lot of investments. So I think we had time. There's a couple of things there. You can. I'm good. These are just some of the co-invest examples that we have, and co-invest Grosvenor runs ours for us. So thank you very much, guys. I'm happy to take any questions if there's anything now or afterwards.
Yeah, if there's any immediate questions for Kieran.
How do clients respond to these types of issues, or this sort of presentation?
Well, first of all, I think this sort of presentation is not a presentation that we'll be doing to a client. When you look at the retail clients, it's really up to the advisor to articulate what's happening in the portfolio construction. And we as a team have to make sure that we give the advisor the right material, the right communication material, access to people like Grosvenor and things like that, so they can understand that and then they can work with their client, because that's part of an advisor's role, is education with their client. However, when you come to the ultra-high net wealths, the endowments, all of those sorts of things, very different. This sort of presentation resonates, especially if you can have a look at what they've got and then put it in context of what they have. That's the key. It's no use doing this on its own and not looking at the way they're looking at the world. So I think that's perception is super important. Is you've got to look at through their eyes, and then you do this sort of presentation with them. And then I think it works very well.
Thanks. Kieran, you spoke about the additional flexibility of MDAs over SMAs. So can you give us an example, a practical example from your perspective of things that you do within your MDA that you wouldn't be able to do in an SMA?
Yeah, so I think if you look at a managed discretionary account, is what we're talking about, there's a much better ability to customize for clients. That has to be done with the advisor and then also with the investment team. So what I'm getting at there, we will see client preferences, also what they hold when they come into the firm. There's an ability to deal with those. When it comes to these private sort of assets, there will also be clients that potentially don't like what we're doing in that. You can customize, you can take that out. You could go from what we have, which is a unlisted version using Grosvenor within a fund-to-fund structure. You might decide as a client or an advisor, actually, I don't want that. I can then substitute in listed versions of that. And that's absolutely appropriate. So it gives that ability for the advisor to say, well, I want to do something different, or the client, I want to do something slightly different. When it comes to the underlyings we're talking about, it's not making a difference because we're not using that. I think in the SMA world, that personalization, though, is just much more difficult today. Thank you so much. Thanks, everyone. Thank you.
Join me in thanking Kieran, and Kieran will be joining us for the panel discussion at the back end of the session.